Good afternoon and welcome to the Dairy Signal. Today we have Ben Buckner, Chief Grain and Dairy Analyst with Ag Resource Company here with us today for another market update. For those that are new, we encourage everyone to take advantage of having Ben with us live over the next hour and submit any questions you may have. To ask a question, click the three dots in the bottom right corner of the video screen and select the Ask Question button. With that, Ben, I will hand it over to you.
Okay, well, thank you, Amber. Always a pleasure. Welcome, everyone. And as usual, we will get right into it and start kind of at the highest level. And that being, milk has been more interesting than it has been price-wise. And we'll talk about kind of some emerging, maybe short-term threats to global production. And that's been the thorn in the side of milk prices for a long time. Is that starting to change? The biggest concern that we have, though, and we'll lay out this case, is that feed markets, feed prices, which have been moving up, move up significantly over the next 8 or 10 months. I guess the issue is the burden being placed upon really, northern hemisphere weather, U.S. weather in the month of August has gotten incredibly high, and then in South America, we can't really afford at this point any additional supply disruption, and that is kind of rooted in geopolitical chaos, which has been calm at times in early summer, is now back full go. Maybe the most chaotic it's been when we think about the details of what's happening in the Strait of Hormuz again and Red Sea now. So a lot of energy is being cut off from the world market, fertilizer as well. Second war that has kind of lingered in the background for a long time, but that is between Ukraine and Russia. Ukraine on offense now, to the point where for the first time since 2022, can confirm that certain ports, pretty key ports in the Black Sea of Russia's, have been either shuttered or are only running half time. So once again, kind of like 2022, there was pretty decent production of wheat in the Black Sea. I think pretty sizable corn crops being made there. But if you can't get access to it, then that funnels a lot of demand to every other market, including the US. So geopolitical uncertainty is dominant. The forward evolution of war is kind of unknowable, but they're pretty important to us. And I guess that today, we can't see any indications that there's resolution forthcoming anywhere. So we're going to assume that this stays pretty chaotic for the foreseeable future. And so far, there's been no demand destruction when we think about corn, soybeans, wheat, soybean oil. So this collision between war, adverse weather, drought in Europe, record corn demand, which is pretty easy to see, does have concern for $6 corn, even higher prices 6, 7 months from now. And again, we can't see the future with precision, but that's the risk that we'll kind of lay out during the signal. So to start with, we have seen some, fortunately, the milk market finds some life. We are not just straight down, very boring markets. We have seen recoveries, and I think those are rooted in one, the flow of money. Speculative, funds were very, very short of class three, but that position has been unwound intermittently because we do have, I think, actual threats to production. If those are short-lived and can be fixed, that may be the case. But for the next 60 days or so, I think we are on balance going to see less milk produced than we expected, and probably certainly less milk than was produced in May and early June, the seasonal peaks in the Northern Hemisphere. And that is rooted in, I think, the world's real production threat of all kinds. And that started with, what's become crippling drought now in Western Europe. And it's kind of expanding. So now it's pretty concretely the Western third of Europe experiencing historic dryness and certainly historic sustained heat. So what we are looking at here is June 1st to July 21st, percent of normal rainfall on the left, and the average departure in temperatures on the right. It's pretty easy to see, France, Europe's largest producer of most things. Germany produces more milk, but otherwise, especially with respect to crops, it's France that dominates. 18, as low as 8% of normal rainfall, generally speaking, 30 to 40% over the last, 60 days. It's not good. Spain worse. The eastern half of UK, where a majority of feed crops are produced in the UK, also 40 to 50% of normal rainfall. There's really no sign that this drought ends or there's any relief for the next 2 weeks. So now we can kind of see into August 6th or 7th. No change in the pattern, stays very hot. Actually, it's hotter certain days in France. And so after that, I think there's, it's not salvageable row crop yields. Yeah, at that point, we're just kind of looking to fill reservoirs, rivers. Eventually, there's going to be the need for more water ahead of winter wheat seeding. But this has been the biggest issue with respect to changing global crop production and to some extent global milk production, or at least European milk production. So we kind of go back and just wanted to tell the story why I think this is kind of an issue for class 3 price discovery. It's hard for us to be real bearish here, at least to get for the next month or so. Here are maximum temperatures recorded in the month of May in the European continent. And again, we kind of want to focus on France, Spain, the United Kingdom, where things were the worst. And so 92, 97 degrees in really the heart of France's agricultural belts. This is where most of the corn is grown, kind of the southwest corner, but also where a lot of dairy operations exist. So we kind of see that, that's in the rearview mirror now. But now that we're getting production data, it's pretty clear that heat, if nothing else, did negatively impact milk production in France and Spain, where, again, heat has been the worst and where there's really been, for all intents and purposes, no rain for the last month and a half. So France, second largest milk producer in Europe. Spain is the sixth, each shooting for at least self-sufficiency, if not, net exports of dairy products. So French production, 2.1 million tons, down fractionally from last year, and down last year for the first time in about 14 months. Spain also down fractionally from last year, and down from the last year, the first time in 24 months. So again, knowing that heat dryness has impacted Western European milk production in the month of May, we can kind of extrapolate, and this is going to continue, I think, through June, July, and probably the month of August. So it has not meant that much for U.S. milk price discovery yet, but I do think this keeps intact what we have seen the last 2 years, and that's just incredible cheese export demand. Do certain European countries import a little bit of U.S. butter? That's also, I think, on the table once again, just because on the margin they're producing less than everyone thought, just 30, 45 days ago. So, I think that does also beg the question, are we kind of at like peak European production? And I think this can be salvageable. Temps will cool. I think the drought does get busted at some point in the next 3 or 4 months. But we're no longer just every single month European milk production's up 2, 3, 4, even 5% year over year. That period is probably come and gone. So kind of are we starting to turn the ocean freighter around with at least respect to this monthly data, world production, European production? I think that's probably the case. I think the world milk production won't be as exciting to the bears as it has been the last year or year and a half. So European production of milk down on the margin. That's kind of occurred, especially in the last couple of weeks, as we saw this, pretty sizable short position in Chicago to the tune of 1.3 billion pounds of class 3 milk. And it was kind of not historic, but this short position was at the upper end of the historical record, going back about a decade and a half. So it's not surprising to us that as you see the market oversold, sub $17, $16 spot market, and funds are very, very short. You've got the first real fundamental issue in the world milk market in that position. Was covered pretty quickly, starting 2 weeks ago, and it's still being covered, every other day currently. So again, I think that's sort of what's rooted behind this. So I think you have to raise your price floor at least a little bit relative to what it was 30 days ago. So we've had this excitement in the market. I guess still the question is, though, what to do with it. And it is still to us locking in margins. And that does include hedging forward milk prices. Despite what's happening in Europe, pretty adverse heat, dryness in a lot of the western United States, really west of the Mississippi, not doing very well weather-wise. We're still not at the point where I think end users panic for supply. I don't think like we saw $23 class 3 milk. That's not really the issue. And then even thinking about what we're going to get into with feed costs going up. In a year like 2021 or 2022, feed costs were incredibly high, but we also did not have an abundance of dairy products. So the milk market had to follow. It had to guarantee some measure of profitability worldwide, so we were producing enough dairy. The concern now is that we've got a lot of milk in the U.S., clearly, a lot of dairy products, no real threat to that in the short term. So do we see feed costs go up and the milk market's kind of blasé about needing to keep up, at least for a quarter or two? Q1 is always our biggest concern with respect to hedges, and that's still the case. So I think kind of targeting from these prices, 20, 40 cent rallies in class three, I think those are hedges, especially as you get into the winter months. And we kind of want to buy feed currently or on each and every correction. Because also what we got, this kind of brand new out yesterday, U.S. milk production in the month of June was 19.7 billion pounds, up 2.3% from last year. That was a little higher than we thought. And so I think we've kind of had to adjust our numbers, which we started to change just last week because of adverse heat, dryness, central U.S., export demand, et cetera. I felt the milk market was getting a little tighter. Maybe this kind of pushes this off 30 or 60 days. Because at its core, it's still about cow numbers. And I think this is important because we have seen at times, monthly national milk yield be pretty unimpressive, including in June. Per cow output was up just 0.3%, and that's the same as it was in the month of May. So not very impressive. Though I still think it's going to be hard to grow milk yields from very, very high levels nationally. We're very good at producing milk. So what is the next story in terms of improvement? But I think what kind of offsets a lot of that, and maybe even to some extent offsets, this really, really hot summer so far, is just there's a lot of cows being milked. The herd sizes are still growing every month in Texas and South Dakota. I still think that's a function of beef. And if you look at Kansas, South Dakota, and Texas combined, cow numbers there up 75,000 from last year, and also up 25,000 in Wisconsin, 4,000 in California, and I think 13,000 in New York. So it's kind of nationwide. So even if you were to kind of extrapolate, milk yields are unchanged from last year for the next 6 or 7 months, or probably up fractions of 1%. You're still kind of left with sizable U.S. milk supplies that famous last words, probably can't be threatened in the medium term. So there's going to still be a lot of milk. And so this is kind of in the eye of the beholder. And I think that's why the, even daily, weekly class 3 milk settlement is kind of unsure what to do with itself. So I do think that once we run our numbers for the new cow number data, weather, unimpressive yields, we're kind of left with national milk production calendar year 2026 being 236.4 billion pounds. It's down 200 million from the USDA's forecast. And so still very high, 2% annual growth. Looking at the historical record, pretty sizable. But also this would be the first downward adjustment from USDA in their August report, for the first time in 12 months. So you kind of spin it both sides, but I think there's, on one hand, kind of like in Europe, does the bearish impact of these really, really large milk production totals start to lose its luster moving forward? I think that is probably the case. On the other side, when we're thinking about, managing risk, locking in margins, there's still a lot of milk. So each side will have their day in a week, but we're not looking for some new structure in the price of milk for the rest of 2026. We're also looking at, butter, cheese, cold storage, so stocks. We're not really seeing any indication that there's been disruption in supply and demand the last 30 days at least. So these new numbers will be out tomorrow. We are looking for butter stocks on June 30th of 335 million pounds. Down from the last 2 years, but the discrepancy between this year and last is getting smaller and we're producing a lot. So think about, daily or weekly butter supply and demand. It's not overly tight. We're also looking for American cheese stocks, generally unchanged on June 30th, up a little bit from last year. And so you're not seeing the threat of end users being forced to play something like musical chairs, get your supply before your neighbor does. Like we saw in 2022, 2023. That would have to be the next shoe to drop, I think, to be real bearish of dairy. And there could be a case for that being built in 2027, depending on how this current and incoming super El Nino kind of shakes things up worldwide. But again, if we're looking at managing risk from now until March of 2027, still selling rallies and definitely want to lock in, income over feed, as best we can. And also, I think that when we think about this strategy that we've had for a long time now, and despite whether Europe and the United States, lower European milk production, that's still our strategy, selling rallies, hedge and feed, supply coverage. Because this is brand new. This is this week in the global dairy market. So we watch the sort of bi-weekly global auction price of all things. And as of 2 days ago, the global auctions cheddar price fell another 9 cents to $1.63 per pound. That's the lowest since winter 2023. The global butter price fell 1 cent per pound to $2.42. So the global market is working to shed a risk premium, not add it. And it can see what's happening in Europe, what's happening weather-wise all over the globe. And this is what we've got. This is the snapshot of the global market this week, at least. So I'm kind of waiting on panic, some kind of scramble for existing supply. That's just not been the case in the dairy space yet. So I think if anything else, it's this slide that still keeps our strategy of selling rallies in place. We also finally, just kind of thinking about seasonal trends, we've shown these every probably once a month. We just wanted to highlight, spot class 3 milk, what has happened during the middle or end of spring, sometimes late winter, and it's just very hard to avoid corrections. I think something that we've thought a lot about this year when it's comes to managing feed market risk, corn price, and I think milk price as well, these seasonal trends, you get in trouble if you try to get the day or week exactly, but they exist for pretty strong structural and fundamental reasons. Thinking about corn, which we'll touch on, tends to peak in May, tends to bottom in August, is always weak in the month of June. And so that's something you can think about, check your brain at the door and trade accordingly. But I think that it's hard to change these trends because, the month of June is maybe the one month of the calendar year when there will be producers that are forced to price supply. Especially in South America, there will be a lot of producers and exporters that can't store corn and must get rid of it at whatever the market's price is. And that can't really be adjusted unless there's just crippling drought somewhere. The same thing with dairy. We start to kind of upswing yields, production, Q1 and into spring flush we all know about. And also just per day consumption of butter, cheese, whey, and powder is at its lowest. So the market, which is pretty short-sighted, but always kind of imbalanced in Q1. So we're kind of thinking you can see $17.50 class 3 milk, Jan, Feb, March 27. I think that we cannot eliminate the risk that you go down to something like lows of the last couple of years, whether it's a little bit below 15, something like 16. I don't think we can avoid those trends without some kind of black swan event occurring in the dairy space or ag market space as a whole at some point in the next couple of quarters. But here is kind of the real issue and what we want to communicate now, and the excitement is going to be in the feed space. Corn, soybeans, and wheat both kind of all caught in the crosshairs of needing acres next year. Who will get them? Which market will not get it? The burden being placed on forward weather patterns. We've got Super El Nino, and we don't really know what that means for weather patterns, so it's very, very uncertain and unknowable. But from a very high level, we want to keep this very simple. So we think that corn, clearly it's been happening, but corn, maybe to some extent soybean meal, higher lows, higher highs. And so we saw the corn market peak, if you looked at like March or May, $5, 10 cents, 5.20. We think that we're going higher than that in winter, spring of this year. And the reason is not terribly complicated. So one, we've got fewer U.S. acres. We think that will be finalized in a couple of weeks, probably. But we so far, to the best of our knowledge, the U.S. planted 3.5 million acres less of corn. So even assuming favorable weather, the crop's going to be down 1 billion bushels. So we've lost 1 billion bushels of supply. Drought in Europe that we've kind of highlighted can't be salvaged at this point. Again, there's no rain, temperatures in the 90s, 15 degrees above average in France, the United Kingdom, Spain, parts of Germany. That gets into August 7th. After that, I don't think you can do much to kind of boost corn yield potential or spring row crop potential for that matter. Mediocre U.S. weather so far, and we'll touch on just the differences between this year and last year, but hasn't been great in a lot of places. So, and it's to trim your yield ideas, I think is reasonable. And what we want to touch on is it doesn't take much to really alter the structure of corn supply and demand. We're not looking for a major revision in yield. Yield's not really the big part of the story. Just if the USDA does take its yield forecast down a bushel or two, things get pretty tight pretty quick. War in the Black Sea is, I think, what's new this week. Having ports in Russia be shut down or operating at half capacity. Do we lose 10, 12, or 15 million tons of Black Sea grain. The market can't access those tons. Demand's pretty strong. It's going to be funneled elsewhere, including the United States. That's a concern of ours as well. But just being very simple, war is bullish of corn and wheat because of what's happening in the Black Sea. And then we've got these Chinese trade deals. It's opaque. I think it's fair to debate whether it is followed through in full. But we do think China is going to buy a sizable tonnage of U.S. soybeans, especially compared to last year. And it seems like they need it. This is not just because of politics. And does China buy 50 million bushels of U.S. corn or wheat, 100 million bushels of sorghum? Kind of like yield, it doesn't take much. The balance sheet continues to tighten. So really the story is China's secondary at this point to all the other things listed. And it's just been one thing after another. It's been very hard to identify kind of new bearish input, or for this reason, corn prices are too expensive, soybean meal is too expensive. We haven't been able to run across that in the last couple of weeks. And, we're kind of running out of runway for markets to be concerned about too much supply. Seasonal trends, which are bearish in June, kind of starting to level out, turn a little bit positive. That runway, again, is getting short. So we've got these uptrends intact in the feed markets. And again, our concern is that there's a lot of upside. And certain dominoes may have to fall. I don't know if we can resolve the Black Sea conflict. Maybe there's another grain corridor deal established in the next 30 days. At that point, war risk premium will be extracted from the markets, but that is unknowable. The growing season, not by any means over, but as we're starting to peek into the early part of August, we can kind of see the end of this and looking at a lot of moisture deficits, not only in Europe, but in a lot of the central United States as well. And generally speaking, and we've talked about this every 2 or 4 weeks as well, just kind of squint your eyes and think about, when do you buy and when do you sell corn? When do you make those hedges, if needed, at the Board of Trade? It's pretty easily you sell June, July, or so you buy in June, July, you sell in April, May, and I don't think that can be disrupted this year. So if we add 20% of value to the price of spot corn, that gets you to a spot market that's about 510 or 515. Forward market, pretty easily 540 or 550. And that's kind of a base case, I think, when we think about seasonal trends. So even if there were geopolitical calm, unremarkable weather, favorable, non-threatening weather, you want to buy corn by the middle of August anyway. And that is still 3 weeks away, but it's only 3 weeks away. So I think, again, the tides are kind of starting to turn. What's the story to the downside in feed markets after you go another 2 weeks of the calendar? So again, I think these seasonal trends hold. And what's kind of new, and I think it exacerbates this recovery, is just, kind of staying, calm, cool, collected. When you see some big, high impact event, just adjust your balance sheets accordingly. And everything is kind of starting to signal this growing feed, corn especially, but feed market production deficit. So I think that France, again, the largest producer of corn in Europe, going through something like the U.S. did in 2012, to the point where they already planted lower acres, the lowest on record in Europe, going back to 1999. But cutting your corn crop in France, Spain, United Kingdom by 35 or 45% from last year is pretty reasonable. I don't think there are really unreasonable forecasts for production there at this point. The spot French corn market has rallied to $7.50 per bushel. Now that is a non-GMO contract that's part of the deliverable specs in Paris. So there's always a premium. It's generally above $5.50 no matter what. But this is definitely starting to signal the need for pretty large imports of corn into Europe. And so it's non-GMO. It's a valuable commodity, but we kind of track the spread between Matif in Paris and the Chicago Board of Trade has gotten very, very wide. So it's telling us something. And the thing again, China, U.S. trade relations, China purchasing U.S. corn or wheat. Let's exclude that from this analysis. Let's just kind of focus on what the European drought does to global grain flows. And we've seen that as the European corn balance sheet has tightened, mostly because they're just planting less of it, they're planting other things. But as that has happened, they have started to seek U.S. origin corn. If you're a company committed to non-GMO corn, you can't buy U.S. corn, but there are no longer any actual legal restrictions to importing GMO corn. And so you've seen it really is the proximity to the United States. So it's going to be Portugal, Spain, uh, Ireland, and the United Kingdom all buying U.S. corn now in bulk. So we've got actual data, pretty hard data through the month of May. Those countries together have secured 230 million bushels of corn. And we've gone from prior to 2021, 0 bushels to 230. And so I think we're on track to get that number to 300 million or so in crop year 26, 27. So that by itself kind of keeps your U.S. corn export forecast pretty high. And just running through the numbers very basically, I know balance sheets are not fun to look at, but we've just, I think, reasonably lowered Europe's corn crop size to 49 million tons. It's down about 8 million from last year. They're going to have to keep things remotely balanced, import a record 25.5 million tons of corn. This will make them the largest corn importing region on earth in 26, 27. I think that we do expect something like 10 or 12 million tons of that to be U.S. origin, to the west coast of Europe. So the European drought added to U.S. corn demand. Europe will be competing with you for what will be finite corn supplies come harvest. And that's, I think, the high level message there. And so we start to kind of think about this, really, really terrible drought in Europe, and lack of yield growth in the United States. And we'll kind of touch on what we think about yields, in more detail. But already the USDA is projecting world corn production in 26, 27 to fall 18 million tons short of consumption. So we just kind of trim US a little bit, take down Europe by another 4 or 5 million tons, and all of a sudden that deficit is now 27 million. And this is important, I think, when you think about the structure of corn, for example, over the course of 6 or 12 months. It is not very often that we have production deficits. This number, 27 million tons, this deficit assumes that there are no issues in South America, from December to April of 2027. And who knows? I can't say anything about South American weather at all today. But if there were hiccups, this number gets to 30 or 34 million tons. All of a sudden, this is the change in supply and demand of feedstuffs and corn especially, has changed pretty dramatically in one crop year. Oversupply, which was in place in 2025, has been kind of wiped out in a matter of months. And that's, I think, the big picture thing. The exporters will bear the brunt of this because trade will stay elevated. Europe's going to have more corn than we thought 2 months ago. They're going to have to import more corn than the USDA is forecasting. That's pretty easy to see. So again, just some minor adjustments in the US, raising world trade because of what's happening in Europe. And suddenly the exporter corn balance sheet, which was pretty loose last year, is now historically tight in 26, 27. These numbers will be pretty fluid. We can't even get to the point where we're measuring demand until after really October 1st. And so this will be changeable, and we'll revisit this, every month or so. But this number does correlate pretty strongly, 8.1%, with the corn market above $5.50. So that is, I think, the new risk that's developed. And again, it's been just one thing after another every week. The implied U.S. exporter and world corn balance sheet continues to tighten and tighten and tighten to the point where this is where we think we are going to be currently. Kind of thinking about global corn prices. So will there be relief from anywhere? We've lost production in Europe. We have probably we know we've lost 1 billion bushels in the U.S. Is it larger because of yield? At times, you have these humongous South American crops and all is well, no change to the structure of the market. That doesn't seem to be the case, though. The Brazilian corn market has bottomed a bit earlier than it normally does. It is up 25 cents per bushel in the last 3 weeks. And every year, our biggest competitor for corn market share is Brazil. Every year that market bottoms at some point in July. But it's happened again this year. Its recovery has been pretty swift. We're up about 50 cents per bushel in Brazil's daily corn index from where we were last year. And I think the story, that's kind of boring, but they had really, really good weather, and several trusted government entities in Brazil have been raising 2026 corn production. I think the state of Mato Grosso, this ag behemoth now, will produce a record amount of corn by 4 million tons this year. As those numbers have come out, the market continues to move higher. So I think that has all been digested. Brazil's ethanol blend mandate is 32%. It's up 2 points from prior to 2026. So I think they're using more of this domestically, and the domestic market will win should there be a scramble for supplies. So Brazilian corn prices are not competitive exactly with the United States, despite having large production. And to that end, Brazil really hasn't been looking for market share since probably the middle or early part of 2023. So the message here is that Brazil has a very big crop. And as the US corn market is starting to add premium, we're looking at very tight balance sheets. The Brazilian corn market is about 10 cents per bushel above the US market. And that has been roughly the case for the last 12 months. I think Brazil's share of trade has stagnated because any growth in demand will be centered on ethanol. And that just kind of takes away from Brazil's exportable surplus. And they're kind of stuck exporting every year something like 40 million tons. So if corn demand as a whole continues to increase, the pie gets bigger, who will fill it? And I think it's going to be the US probably, or at least in 26, 27. So we've got really good demand, terrible weather in Europe, rising trade estimates, lower stocks estimates. What do we to do with US corn yield? And again, the message here is that it still warrants debate. No one will know until we get test plot data at soonest. But the issue to us is, again, it just does not take much. A yield 2% below the linear trend is 180 bushels an acre. That by itself would take something like 200 million bushels off the corn supply. And that balance sheet's already been tightening on a monthly basis since the middle of winter. So what we're looking at here is July 1st to 31st, percent of normal rainfall. And on your left is last year, adequately wet, and on the right is this year. And this kind of assumes that the kind of short-term forecast is correct. Short-term forecast is pretty dry. So there are enough problem areas to us, whether that's, North Dakota, parts of the sort of Southern Plains, Kansas, Oklahoma even, just these things kind of start to add up, especially when we think about the temperature profile in July. Last year on the left, this year on the right. So it's been incredibly hot. And while really no month's weather or weather analysis at all gets you very precise yield estimates, it can kind of get you in the ballpark. I mean, what correlates most strongly with final U.S. corn yield of all the single variables is July temperatures. And so we do think that the national corn belt average temperature will be 2 or 3 degrees above normal. We have seen trend yields be obtained in those years, but most often final yield will be down 1, 2, or 3% below trend, which again is just kind of enough to get things pretty tight. A 3% loss of yield is 179, and then all of a sudden we're kind of no better than we have been prior to last year in terms of yield. We're not done. I think this might get worse before it gets better. Just getting into the very nuanced details, NOAA's or the U.S. Weather Service's 7-day forecast on your left, and the maximum temperature forecast on July 28th is on your right. I'll probably, forecast this far in advance. We'll get details incorrect. All of the forecasts do tend to agree that kind of west of Western Illinois, it's going to be hot. Whether we see temperatures in the hundreds in Kansas, parts of Nebraska, can't know for sure, but it's going to be in the 90s, and then just kind of the acceleration of moisture loss. And one of the things we've been following since its creation is the USDA and NASA's CASMA model. So this is just one of many tools that measures soil moisture. I think this is satellite based. But this is what subsoil moisture anomalies look like as of July 20th in the United States. And so again, it's some places doing well, other places doing very poorly, but the background being it doesn't take much yield loss to really change the structure of the market to accelerate this, post-summer or seasonal recovery in the value of corn, soybeans, soybean meal, and wheat. And so I don't think that this gets fixed at least in the next 5 or 7 days. It's not a lot of rain in any forecast for 2 weeks. So again, on the margin, I think that the market's idea of U.S. productivity will be getting smaller, not getting larger. And just kind of as an aside, again, it's been one thing after the other, which from the very top makes this year kind of a mirror image or the reverse of last year, where everything was going very swimmingly weather-wise. Every single week, we were more or less being forced to loosen grain balance sheets or raise production somewhere because weather was so good or we're getting government data. This has been the exact opposite of that. And so we're looking at Canadian prairies from July 1st to July 31st, assuming the short-term forecast is correct. And now we're kind of worried about Alberta, southern Saskatchewan. Can they maximize wheat, barley, canola production? And I think what we have heard from our friends in Canada is that, this story being told there is that some places are doing pretty well, others are doing worse. Overall, you look at something like soil moisture ratings, crop condition ratings, they're about average. Though I think that, like in the US, net soil moisture loss will continue. But for the wheat market, for example, we think that the USDA is telling us that the exporters combined will produce something like 40 million tons less wheat this year than last year. So that's the beginning and end of the wheat market. If you were to lower Canadian wheat production by 1 or 2 million tons, which is pretty reasonable, that is a kind of a rounding error at this point, then that situation just gets worse. And also in the background, the spring wheat balance sheet is not, in the US, is not terribly loose, but a lot of that hinges upon larger imports from Canada as the cost of those imports go up. The market's, again, starting to signal these pretty, reflect these sizable grain production deficits, globally. And so here is what we're left with. And all we can do now is run through scenarios of all kinds. So there are too many numbers here, but we'll just kind of focus on the colors, the yield estimates, and the in-stocks estimates that kind of spill to the bottom. So you do things like you lower your yield, you have to lower residual disappearance. That is just how that works. Maybe you lower ethanol exports as you're lowering production. And so all of that is accounted for in these. But again, if US corn yield, by the final, or the perception of the market is 179, and again, stocks are close to 1.4 billion bushels. We've gone from 2 billion to 1.4 billion in one crop year. But I think what's telling is that even if you assume yields 184 bushels an acre, which is about right at trend, you've got in stocks just under 1.7 billion. That's down 300 million from last year. So that, I think, is what's changed from us. It's not that you have to lower yield because of weather. It's just the sum of everything that's happening, even if central US weather is ideal, favorable for the next 45 days. There's really no scenario that prevents corn stocks contraction. So that's pretty easy to us, the 9-10 month forecast, higher lows, higher highs. And can we encourage 1 or 2 million additional corn acres to be planted next year? Then all these problems are solved. But wheat needs acres, soybeans need acres. What will the South American crop sizes be? I just think there is more risk to the upside than to the downside with respect to current corn and feed market prices. And you kind of see here, we've got some pretty lofty cash market forecasts. So the USDA's average cash price ultimately is the sum of all receipts. And so if yield's 181 or 179, we've got a $5.50 per bushel or higher sum of all cash receipts. And this is what that looks like. So, again, stocks to use, not overly precise, but we can kind of get this shape and slope of this curve. So anything below 10% really does favor, stocks to use below 10% really does favor an average cash corn price in the United States above $5 per bushel. And I think that's where we're heading. So that's not fully priced into the market. And we've got a lot of existing supplies. We've got to get through kind of crop tour season, harvest. A lot of people will sell at harvest. I don't think there will be a shortage of corn in the cash market for the next 2 or 3 months. And that's important. But it's kind of after that. We know what the crop size is in the Northern Hemisphere. Then it kind of turns into people getting their hands on what supply does exist. And you have this new threat, I guess. We did this in 2022. It's kind of all we can do at the moment is just look at, in order to keep things balanced according to the USDA, both within the Black Sea itself and in global balance sheets, we're kind of relying on Ukrainian corn exports of 23 million tons, unchanged from last year, and combined Russian and Ukrainian wheat exports of 62 million tons, which is at the upper end of the historical record. can we get all this? Can importers, do they have access to all this supply? Is going to be a big question. If Ukraine can only, because of security or cost or insurance issues, only export 18 million tons of corn, well, then you've got to kind of trim U.S. corn in stocks another 200 million bushels because importers are going to come to the U.S. market. And that is, I think, why all of these things put together have been bullish the feed market, but also we just can't find anything that's offsetting today. And at current prices, everyone's making money for the most part. So these are kind of plant revenue to plant cost at an ethanol facility in Western Iowa. So above all costs, which I think just economic theory, you're maximizing production, you're maximizing your corn buying at these plants. And so thinking about how this changes, this calculation, given the benefits of 45Z, very, very elevated RIN values, you probably need cash corn in Western Iowa, for example, at $5.20 before an ethanol plant starts to go unprofitable. And relative to current quotes, that's up about 80 cents per bushel from the current cash market on average in Western Iowa. So I don't think that end user margins or demand is being threatened at these prices, despite everything that's happened. And soybean crush margins are still incredibly historically profitable. This is Central Illinois, and our best guess is about $3.60 for every bushel crushed. So if you do have to ration demand, or if China does start to buy, 1 million tons of soybeans, per week, starting in August or September, then we've got this battle for supply. I think the price of soybeans can absorb a $1 per bushel rally pretty easily. And still, most people are making money. Is it $2 per bushel? So just thinking about, that's not the forecast yet, but that is a risk as we think about all these weather problems, wars going on. And kind of lastly, as an aside, outside of corn and soybeans, there are other issues. So pretty quickly, according to the USDA, we have lost 200 million bushels of U.S. wheat in stocks because of record low seedings. And so the wheat market clearly is trading, above and beyond anything else. The war in the Black Sea, closures of ports in Russia, attacks on Ukrainian grain loading facilities, et cetera. And that's important, and this could be a big deal. So let's just assume that U.S. wheat acres in 2026, 27 are unchanged. And we'll go back to trend yield. So yield recovers, we'll assume weather's fine, but you're still left with a contracting balance sheet. So either the price of wheat stays where it is, and that keeps things fairly balanced, or the market's got to work to buy something like, 1.5 million or 2 million acres. Does Western Kansas lose corn, soybeans, sorghum? Do you plant more soft red, even in the principal Midwest, at the expense of corn and soybeans? And so we're kind of left with this puzzle that's going to be harder to solve than it has been the last couple of years. Drought in the plains, of course, has not been good for Texas, Western Kansas sorghum production. So we've seen crop ratings. The sorghum crop last weekend was rated at 45% good or excellent. A year ago, it was close to 70% good to excellent. So we are taking our sorghum yield down. I think that makes sense. We will have lost about 100 million bushels of sorghum year over year in 2026. And I think that's important to corn, at least to some extent, because we've been using more sorghum than ever to make ethanol, plants in Texas and in Kansas. I think that this production number, if it's realized, will add 25 million bushels at least to U.S. corn ethanol grind. So again, everything that's happening, you're raising demand, you're lowering supply, and that's what's given us these new balance sheets that, if certain dominoes fall, or in kind of worst case scenarios, we're repeating the 2021, 2022 market. Again, just thinking about that as being a risk, given corn prices today are high, but they're not historically high. We can still manage feed cost pretty easily at these prices. So here's kind of where we think, again, these will be fluid. We'll go through this every 2 weeks for every 30 days, but this is kind of the evolution of the U.S. ag space. So even the USDA is projecting stocks down 600 million bushels, combined corn, wheat, and soybeans. Not a stocks building year. Higher lows, higher highs, et cetera. We're concerned that if you don't have just incredibly perfect weather in August here and in South America, from now until next April, that we're going to be losing something like 1.2 billion bushels of stocks year over year. We're kind of back to where we were during the bull market of 2020, 2023. So again, Fluid will be changing these. You'll be the first to know about most of these changes. But again, thinking about this is the risk, I think, in the feed space. Once we get to the other side of yield estimating season, so September, October, are we kind of off to the races if weather is just not very, very good everywhere? So that is the spiel today, clearly centered on feed price risk. But take a look at your balance sheets. Margins are good today. If they are, we like locking those in, into the winter months of 2027. So as always, thank you for your time. It's going to be a lot of exciting things to talk about in the next couple of weeks.
Alrighty, well, thank you, Ben. That was a lot of information. We did have a question come through from a viewer, and it reads, cattle values started to move down and some fear that will erode the calf value for dairies. Do you see this grain issue impacting calf or feeder prices?
Yes, a very good question. I don't think in the medium or long term that it will. Tomorrow we get the USDA's cattle on feed, but also biannual cattle inventory report. And what we're going to be looking for there is sort of replacements, calf crop. We don't know exactly what that number is going to be, but you can kind of back into it. And I don't think the beef calf crop's gotten much larger in the last 6 or 12 months. So if prices based on supply and demand, I don't think there's the engine for growth of the beef cow herd still. Clearly, we've all gotten used to high prices. The beef market's been, I think, really in a sideways trend, very volatile, but sideways trend. So no, I don't think so. And in fact, I think the high feed costs will hinder this. And what kind of kicked this off many years ago was drought stretching from, and not just the Central Plains, but from like the southern Canadian prairies into northern Mexico. It's kind of the entire, I know Mexico is different now, but the entire sort of supply chain being negatively impacted by, worsening pasture ratings, lack of grass, high feed costs. So I don't think that this is helping the beef production issue. So I think beef prices, calves are going to stay pretty elevated. For context, though, the beef and cow markets do often peak in the first half of summer. So I think this is mostly rooted in seasonal trends, and then those kind of kick back in after November, December. So it's going to be an emotional roller coaster, but I think the price of beef and cows stay pretty high.
Okay, thank you. Just to finish off this episode, what are a couple of key takeaways that you want our viewers to take home with them?
Yeah, I think so. Talking to some dairy operations we work with is, go look at your P&Ls and think about feed costs. Think about what you can do in the physical cash market for corn, for example, into Q1 of next year. Basis probably not terribly strong. Flat price not terribly strong. I think we want to pass this growing risk, 2 wars, U.S.-China trade, adverse weather. Let's pass that to somebody else and just produce a lot of milk. I think that's the take-home point.
Alrighty. Well, thank you, Ben, and thank you, everyone at Ag Resource Company for their continued support of the Dairy Signal. Have a great rest of your week, and we will see you next Tuesday here.